And welcome back. In the previous session, we started off with an introduction to equity portfolios and a little bit about the role of indices in passive portfolios, active portfolios, and semi-active portfolios. In this session, we're going to take a look at portfolio styles and a little bit about the way that portfolios are managed. When we're talking about styles, the most common styles that we think of are the value and the growth style. The value investing style is essentially concerned about whether or not the equities that we're investing in are possibly overpriced or whether or not they're a bargain. When we think of the value investing style, probably the most common name that would come to mind is Warren Buffett and his major fund, Berkshire Hathaway. Essentially, Warren Buffett, throughout his entire career, has been looking for the bargains, perhaps railroad companies at a certain point in time, mining companies, consumer goods companies, insurance companies, and the principal criteria for investment has been that it's underpriced. Essentially, we look for things like low price earnings multiples or relatively low market to book value ratios, the Tobin's Q that we sometimes refer to. And essentially, the rationale behind a value investing style is that value investors expect earnings to revert to the mean, that the company's value will eventually depend on its ability to create positive cash flows, and that earnings can be temporarily depressed because of a trend in the market, but eventually they'll come back to normal. It also assumes that many of the stocks that we might buy are overpriced. And we think of the tech stocks today that are significantly trading above their long-term normal price and with very high price earnings multiples. Those are thought of as glamour stocks, ones that everybody talks about, and as a result typically are overpriced. So investors who are interested in value investing would avoid those. Now, the risks with this approach, the most important inherent risk, is that stocks might be cheap for a really good reason, and there may not be a reason that we are aware of. There may also be a possibility that we are right, but it'll take so long for us to be proven right that it won't make any difference. The opposite approach to this is a growth investing style, and essentially tech stocks, biotech stocks, companies like that have great growth potential are often thought of as being underpriced according to growth investors. And they say that the price earnings multiple misses out or doesn't actually fully represent the value of potential growth. So essentially it says that there is and there should continue to be a high premium for high growth companies. Of course, the risk here is that growth may fail to materialize. Now, a couple of other alternatives approach. One of the most common approaches since 1988, when it was first proposed by William Sharpe, is a returns-based style analysis. We kind of understand the way that this works because we saw it in the foundations of the CAP-M model that Sharpe is also largely responsible for proposing. Essentially, it says that a portfolio can be defined by the nature of its return. And it says we can regress the portfolio return against a set of indices. What does our portfolio look like in terms of beta relative to our index? And it invokes the standard rules for an index being effective, that it has to be mutually exclusive, that it's separate from all other classes of investment opportunity. It contains all of the different possibilities that an investor could be interested in investing in, and that the risks are not going to be the same type of risk, that they are not highly correlated. Essentially here again we talk about an index beta, and that the coefficient should be non-negative and sum to 1. And that would provide us with a type of a normal benchmark. Advantages, well, it gives us, it characterizes the entire equity portfolio, makes it easier to have portfolio comparisons. It brings together all the different parts of the investment process. Different models give similar results. There's replicability in our approach. There is a clear theoretical foundation based in all of the classical financial theories that we've looked at in this course, in our corporate finance courses. Information is publicly available. It can be executed quickly. It's cost effective. Disadvantages, well, it may not be consistent with the fund's current style. And indices might be misspecified, leading to under or over investment in certain types of assets. An alternative approach to this is a holdings-based analysis. And essentially it says that for this, we're going to try to understand the nature of our holdings by similarities in things like the value versus growth, for example, forecast growth, variability of the earnings, and perhaps sector weightings. So essentially here we're saying we're going to establish a number of categories within our holdings, and say we're going to be particularly heavy in value versus growth, small cap, large cap, industrials, financials, and so on. Now, of course, this is going to require judgment in order to determine the actual positioning of each category. For example, is a company like Apple really a technology company, or, as Warren Buffett now says, is it a consumer goods company? Advantages, well, it provides a clear characterization of each position within our portfolio. It makes it easier to compare individual positions. May help us to identify changes in our overall style of our portfolio more quickly than the returns-based analysis. The disadvantages, it doesn't reflect the way that managers actually think about individual security selection, requires judgment for classification, as we mentioned earlier, and it may be more data intensive and require more specialized information than a returns-based analysis. Yeah. We have already talked a little bit about equity style indices, but here we're actually taking a look at indices that are designed to emphasize the effect of things like growth versus value. And there's also a mid category, things like blended, a little bit of growth and a little bit of value. Some of the factors that may be required in order to make that type of distinction include things like share price, earnings per share, dividends per share, book value, and growth. And this kind of approach uses a holdings-based analysis to classify the index components into our different styles. We say that style indices would preferably be mutually exclusive, but they may also overlap. There's always going to be a gray area on the edge. And so essentially, this allows us to say that, well, we're going to be principally this type of thing, but we could be a little bit of that kind of thing. And there's an opportunity for perhaps a little bit of a shift in style, or to be marginal. Here we can see a textbook example that compares a particular portfolio against a market benchmark. Now, we see right away that our portfolio has 30 stocks, the market has 750. So we're not going to be able to replicate perfectly the entire benchmark. We're a little bit smaller in terms of our average market capitalization. So we'll say we're a little bit small cap, 37 billion versus 45 billion average market cap, not small at all. A little bit higher yielding, lower price earnings multiple, perhaps there are more bargains here. And the same thing with the price to book ratio, a little bit below or significantly below the average for the market. Again, perhaps a bit of a bargain. Earnings per share growth, a little bit lower. So just looking at these factors, we already get a feeling that this looks like more of a value proposition. It's not got as much growth, it's got cheaper assets in the portfolio. They're a little bit smaller than the average for the entire market. And we can see how the construction varies as well. Under sectors, we're we're significantly overweight when it comes to consumer discretionary. So that is going to be one distinguishing factor. The next line down, we can see that we've got 5% consumer staples. The market has got 10%, so we're underweight when it comes to consumer staples. A couple of other things that kind of pop out right away. We have a lot less IT and telecom in our portfolio than the market. All of this suggests this looks like a value portfolio. Now, we can take a look at some of those factors that we've already described and put those into a matrix, perhaps something like a 3x3 matrix, looking at two different factors at the same time. In this case, something like market capitalization versus style, value, growth, and the blended or core. Our portfolio style can be characterized by taking a look at each of those boxes. Here we have an example from Morningstar for a particular mutual fund called VGEQX. And if we look at the holdings in this particular portfolio, we can see that on average, the holdings are larger than the average for the market. They're in the top right-hand corner. And by being on the right-hand side versus the left, they're more growth. And so they're in between core growth and high growth. Over on the left-hand side, we have value stocks. So overall, it appears that the weighted average of the holdings are right on the line of high growth and large, right in the top part of that 3x3 matrix. We can also see that there is a shaded area that surrounds that and essentially says that while there may be some holdings that are outside of that exact location, they are mostly located in the top right-hand corner of that style box. So this fund is principally a growth large cap type of fund. Now, one of the things that we also know that happens is that over time, successful portfolios will attract more and more investment, and it becomes harder and harder to replicate the success in that portfolio. Perhaps our portfolio is driven by 5 or 6 really successful holdings, and that becomes harder to replicate over time. So as new money comes in, quite often we see a bit of style drift. We started off being a growth type of portfolio, and over time we've added more core holdings, so we're starting to look like partly growth and partly core. It's a problem for investors who are buying into a certain proposition and basing their estimates of the future on past performance. So there are problems with this. If we hire a manager because we want value exposure, we don't want to see a style drift towards growth. And the manager themselves may also not have as much expertise in picking stocks that fit into that different style. Again, the same textbook example we looked at before with the same market benchmark, we see that our portfolio has now got 45 stocks. So we've increased the number of stocks. The size of our investments has become larger. Dividend yield has fallen. It was 3%. Now it's only 2%. Our price earnings multiple is the same as the market. Before it was below. Price to book has also risen. And our earnings per share, in fact, was below the market. Now it's above it. And how has this happened? Well, we have got less consumer discretionary overweight in this portfolio. We've added quite a bit of IT. We haven't added telecoms, but and we've also added a bit more consumer staples. So we've shifted our portfolio. It's drifted from what made it successful at the beginning, being largely a value portfolio, to being pretty much a core portfolio. It pretty much matches the rest of the index. So our holdings-based analysis tells us this is nothing special. It's not different the way that it was before. Another very important term and a very important subject, socially responsible investing, is increasingly part of investment decision making. Essentially, it says that ethical and societal concerns need to be taken into consideration when making investment decisions. And so that means that the decision process, or our stock screening process, essentially needs to screen out some things like gambling, tobacco, firearms, perhaps certain geopolitically sensitive areas in the world, and perhaps have positive screens that are going to include things like high labor standards, good corporate governance, good social image. And these screens might also be defined or designed to reflect our own client and their particular interests and concern. It's a lot easier, for example, if your clients are university foundations, to establish yourself as having a socially responsible fund. It can also help us to do well by doing good by avoiding investments in industries where we expect significant bad press from negative externalities, those oil spills and major public relation disasters. And we should choose a benchmark that reflects those exclusions, which becomes harder to do, but we know we can't do that because you can get a benchmark, you can get an index that will follow just about anything. Another concern is that not all of our investments have to be investments that are made by buying. We can also have short selling investments. Many portfolios don't do short sells, and if that's the case, then you don't have to read any more of this material. If we do long investing, we hope to create alpha. If we can do short selling, we can have alpha on our long investment. And say we have $10 million of long investment, we can invest a substantial part of $10 million in short positions and earn just as much alpha, in theory, on the short sales. So you can have two alphas. You can have an upside or a long alpha, and you can have a downside or a short alpha. A market neutral strategy says, we would have no beta with our alpha uncorrelated with market returns and combined with various sources of the beta. In other words, a portable type of alpha. You can have twice the negative alpha, though, on the downside, if things go the wrong way. Imagine you've got two stocks. One of them is Procter & Gamble and the other is Tesla. And you're betting short on Tesla and you're betting long on Procter & Gamble. Well, Procter & Gamble falls, and so you end up with a negative alpha on Procter & Gamble, and Tesla does well, and you end up losing on the the short position. So you end up with two times alpha, two times negative alpha on the downside. Essentially, this is a type of leverage, and it can magnify alpha, but it also increases the risk. Short sales may actually be more efficient than trying to pick winners by long investing. And that's largely because not everybody plays in this game. It means that when there are successes to be had, there's a much smaller pool of winners. It's kind of like picking lottery numbers. If you pick the numbers that everybody else picks, birthdays and numbers between 1 and 30, for example, you have no different chance of success if you pick the higher numbers, or the numbers between 1 and 30, but there'll be fewer people with whom you have to share your winnings if your numbers are 35, 36, 47, 48, 49, because fewer people pick those numbers. Same thing with short sales. Short sales are going to be a source of abnormal returns of excess profits, but there's a smaller pool over whom that you have to share them. So fewer investors are looking for overvalued stocks that need to be shorted. Short sale opportunities may also be irregularly distributed because they may occur because of special negative events, an accounting fraud scandal perhaps, or a failure of management, or a natural disaster even that may result in that. So they're not normally distributed. They don't happen on a predictable scale. And another reason is that investment banks are more likely to promote stocks than they are to talk them down. And so sell-side analysts who work for those investment banks are much more likely to issue buy and hold recommendations than they are to issue sell recommendations. Now, about rebalancing a portfolio, selling disciplines, when do you sell? Well, there are several reasons why and several processes through which we exercise those selling disciplines. An opportunity cost discipline basically says hold on to the portfolio until there's a good reason not to. Sell when there's a stock that represents a better opportunity. Perhaps we have a rule that says if we start to see more than 2 months or 2 quarters of poor performance from a stock, we should sell it. So deteriorating fundamentals. We may have a valuation level sell discipline that essentially says sell whenever we reach a particular valuation. Anytime the price earnings multiple exceeds 25 times, that would be an indicator to sell. And we may also have a process in place that says whenever we get 10% above our purchase level, that would be sell, or perhaps 10% below, that would be our stop loss selling position. We have a number of other types of indexing strategies which we haven't covered and we don't cover in a lot of detail. We can create derivative-based indexing strategies that essentially say hold a core portfolio and use derivatives to increase or decrease risk exposure, risk on, risk off. We can even do this with cash balances by holding a large pool of cash and using index long and short positions to create that equity exposure without actually having to hold the equity. A stock-based approach basically says we generate alpha by selecting stocks that are going to outperform, and this is separate or different from the active management that we talked earlier about because it's using that position, increasing that risk-on position in order to minimize the tracking risk. Now, active management is largely described as the production of alpha. How do we produce alpha? Well, essentially, alpha is going to be a product in this particular form of measurement, measured by the information ratio. Saying information ratio tells us that our ability to produce alpha is going to depend on our access to information and the number of trading opportunities that we have, the breadth of our trading experience. So in this equation, IR is equal to IC times the square root of breadth. And the information coefficient, IC, is the information that you have that perhaps not everybody can share. The depth of our knowledge, the understanding of an industry. And the breadth essentially is going to be a measure of the number of trading opportunities or trading decisions that we have during the year. So we can make money two ways. We can have one great bit of information that we take advantage of once during that period, or we can have a pool of information that is used to make 100 different trades during that period. So the greater the information or the greater the breadth, the greater the information ratio. We should always invest our money with fund managers who have the highest information ratio. When we talk about portfolio managers later, we'll come back to that information ratio again. And here we can see that there's a little bit of information about creating those information ratios. If you're looking at a straight passive approach to investing, we would probably have no alpha because we can't beat the market if we invest in the market. But at the same time, we'll also have little risk in excess of the market risk. So our tracking error will go to zero as well. Not much exciting there. At the other extreme, full-blown active management, trying to pick the best stocks. Well, if we say that, on average, we managed to exceed the market by 2%, which is not a given, but it is in this case, we would also expect to see high tracking risk, high tracking error. So active management, 2% alpha and 4% tracking error. And for enhanced indexing, we would be someplace in the middle between indexing and active. So somewhere in the middle between 0.5% and 2% for the alpha, and 0.5% to 2% for the tracking error. And this, of course, is just an estimate given from one particular paper. Now, if you're looking at the managers that are going to look after portfolios and trying to understand how best to allocate your funds under management to a group of managers, their ability to produce active return for added tracking risk is going to essentially be determined by how comfortable you are with risk. So risk aversion, the degree of risk aversion that we talked about earlier when we were designing portfolios. Again, that utility function that we talked about, once we've identified our risk and have our risk return trade-off in mind, we're going to look for a utility function that's going to maximize active return, which is going to be dependent on, or which equals the expected return of the manager plus the product of the investor's trade-off between active risk and active return. And, of course, the variance of the active return. Probably easier just to talk a little bit about a picture and see how that would develop into our specific allocation between different managers. Here we have a choice of 5 different portfolios, or rather four managers and a straight index fund. The index fund has got an alpha of 0 and tracking risk of 0. So it's in the bottom left-hand corner, way down here. Now, if we have got another fund called semi-active, again, it provides us with a higher alpha of, in this case, up to 2%, but 2% tracking error, 1.5%, 2% tracking error. Active portfolio A provides us with 2% alpha and 3% tracking risk. B provides us with 3% alpha and 5% tracking risk, and a full-blown active strategy. Portfolio C provides us with 8% tracking risk for 4% alpha. Now, of course, which one you would choose would depend on how you feel about risk. Obviously, everybody wants the highest level of return, but are you going to be happy with the 3% tracking error, with 4%, 5%? And probably we'd like to be somewhere on this horizon. So can we actually reach the horizon if these are the different portfolio opportunities? Well, the answer is, of course, as we saw with corner points, yes, we can take a mix of different types of portfolios and actually replicate that mix. So if, for example, we decided we needed 3.5%, we're willing to take 3.5% risk. So we're someplace in the middle, along the bottom. Well, we can see there's no way that an index portfolio is going to provide us with that kind of return. No, we're not going to have any of that. In fact, semi-active also, putting our money in the semi-active portfolio is not going to provide us with the type of return that is going to be found at 3.5% risk. But the active A will give us some of that, so we'll take about 25% of our portfolio and we'll invest it in portfolio A. Then we'll also take about another, around another 35%, and we'll invest it in active B. And then the remainder of our portfolio will invest in active C, which will put us on that line somewhere around here with about 3.5% active risk or tracking risk and about a 3% alpha. So we've done that by combining some of A, some of B, and a lot of C in order to give us that position that's on the efficient frontier. Now, another way that we can also adjust our portfolios in order to get the best possible return consistent with our portfolio strategy is to use core satellite portfolios. And essentially, we'll say that we'll have an indexed or enhanced index portfolio that's going to provide us with the majority of the returns and be a substantial part of our overall investment. And then we'll use an active satellite portfolio with a similar benchmark to basically complete the investment, perhaps with a focus on a particular style, either value or growth. Sometimes this type of approach is also described as a completeness fund, and essentially here the managers are going to have risk exposures relative to the overall benchmark, and our fund is going to be used to adjust the risk to that of the overall benchmark. And for that we can do this actively or passively, semi-actively or passively. It's something that we have to continually adjust, at least the satellite part or the completeness part of the portfolio. And essentially says we're going to have one portfolio that's going to describe the majority of our approach, and that extra portfolio that will do the best to complete the misfit. And when we're talking about our total return and risk, in the complete portfolio, we'll have to have the true active return, which is our manager's return minus the normal benchmark. The misfit, which is the manager's normal benchmark minus the investor's benchmark. True active risk, well, standard deviation of the entire risk portfolio. And the misfit risk is the standard deviation of the misfit active return. Now, we've introduced beta. That was one of the most fundamental parts of our understanding of how portfolios work. And the beta essentially describes the position of an individual investment within a larger portfolio. So beta is something that we get for free. We can say that we recognize that this company has got a high covariance of return relative to the market, so we should take that company even though we're semi-comfortable with that degree of uncertainty. But the uncertainty is something that we already know about. The alpha is the thing that's unknowable. It comes from information. And so the alpha typically is more expensive. The beta is something that we get for free. Let's go back to the start and say, in a long-only active portfolio, the beta and the alpha are going to be the two sources of return. Beta comes from the market, alpha comes from manager skill. In a long-short market-neutral portfolio, we would expect not to have any kind of beta exposure. The positive beta is cancelled out by the negative beta. Beta we get inexpensively from our index portfolio, and so we don't really have to invest extra. There's no tracking error, there's no extra transaction cost, it's a freebie. In a semi-active or an active portfolio, we have a mixing of alpha and beta. If the benchmark's efficient and offers few alpha opportunities, it can be gained from just using the original benchmark, the beta or the portable alpha. And it gives us more opportunities then to gain alpha. How do we select equity managers? How do we select our fund managers? Well, chemistry is going to always be part of it. Finding fund managers who we can work with, who we can communicate with well. And so people are a lot of that. Do we work well with this particular firm? Organizational structure. Do we have a structure that we trust with a few opportunities for embarrassment? Do they have the same investment portfolio that we have? Is the process transparent and clear? Do they have access to, or are they able to produce, substantial equity research? And then there are the quantitative factors. How do they do relative to their peers and relative to benchmarks? Is there a particular style orientation or valuation approach that they use? And are they consistent with their stated policies? If they say that, this is our approach, we believe in this, but they appear to be quite hypocritical about that, then clearly they're not going to be a good mix. A term or discussion that you'll often hear from most investors is that past performance may be a poor predictor of future performance. And so that disclaimer, past performance is no guarantee of future results, is often part of just about every investment discussion that we have. We see that outperformers may fall from that sterling position of being the head in the industry back into the middle of the pack from one period to the next. And so that also shows that the ability of one firm or one investment manager to outperform may be significantly exaggerated. And we'll talk a little bit about that when we look at ethics later. So consistency tends to be important. Periodic outperformance is not going to be as useful as consistent, slightly above average performance. How do we reward our fund managers? There are two principal methods that we use to reward fund managers. We give them a percentage of the funds under management in an ad valorem approach. Perhaps we pay 1.5% or 2% of the total value of the funds under management to the fund manager as basic compensation. That's used to keep the lights on, to pay for the basic salaries. The second source of return is performance-based. And this may be as high as 15 or 20% of the total profits to the investment after all of the costs are calculated. So if you hear terms like 2 and 20, it's 2% ad valorem and 20% performance-based, and sometimes we refer to this as the carried interest. Performance-based fees then often include measurement of or identification of a high watermark. In other words, if the fund rises to $1 billion and then the next period falls to $0.9 billion, we will use the previous high watermark as the identification of the point at which the bonus system is going to start. So they have to earn their way to the hole before they start to take that performance-based compensation. There may also be an overall fee cap to stop provide a disincentive to take unusual risks. Another part of the process may be to produce an equity manager questionnaire, essentially trying to identify some of those qualitative aspects: the organization structure, personnel, philosophy, research capabilities, historical performance, and also the fee structure. When we're talking also about our approach to security selection, and this is a major topic that we're only basically touching on here at the end of this session, we have a top-down and a bottom-up approach to security selection. I have discussed the top-down approach. In fact, at the beginning of each class, we start off by looking at the things like the economy and sectors, and then perhaps things like currencies and countries, and then finally stock selection. So it starts off with the macroeconomic factors and works its way down to the individual merits of a single company. A bottom-up approach identifies the factors that we're going to use to identify success or potential within our investment universe. So are we looking for companies in certain industries that we think are going to be key to the future? Perhaps certain kinds of battery technology or certain types of minerals, or if we think these things are going to be important, those would be some of the basic factors. And then we're going to use our screening model to identify companies that pass that screen. And from among those companies, we'll start to take a look at some of the firm fundamentals. And that's pretty much the end of our session. We've had a chance to take a look at some of the style approaches that are used for investment. We've given them a name. We've looked at some of the pros and the cons of each. We've talked a little bit about how to manage our fund. And then finally, we've looked at security selection. In this course, we don't get into many of the interesting nuts and bolts of equity valuation. That's something we do in other courses. And I hope I'll see you in one of those. Until next week in class, I'll see you then. Bye for now.